Hey there, welcome back to InvestLike. Today, we're stepping into the mindset of one of the most respected investors of all time, Peter Lynch. If you're tired of trying to decode the stock market and following tips that don't pan out, this is the video for you. Lynch transformed the Magellan Fund at Fidelity from a relatively unknown entity into one of the best performing mutual funds ever. What's unique about Lynch? He didn't follow Wall Street's complex formulas or insider knowledge. He relied on what he called investing by observing, seeing opportunities in everyday life, from grocery aisles to local malls. In this video, I'm breaking down Lynch's 3 standout investing principles. We're going to cover how he turned simple observations into incredible gains, the importance of researching what you already know, and his strategy of only holding on to stocks with true long-term potential. By the end, you'll see how Lynch made investing feel less like gambling and more like a thoughtful decision-making process. Let's get started. Section 1. Invest in what you know. Lynch's first rule is deceptively simple. Invest in what you know. For him, this meant starting with the industries and companies you're already familiar with. He believed that average investors often overlook the opportunities right under their noses. Think about it. If you have a favorite restaurant that's always packed or a new tech gadget that everyone's raving about, you might be onto something. Lynch felt that everyday life is filled with these clues. To Lynch, understanding a company from a consumer perspective gave him a unique edge. He famously spotted opportunities by paying attention to products his family liked, like Leg's Hosiery and Dunkin' Donuts. The logic? If regular consumers love the product, there's a good chance the company is financially stable and might grow. Practical tip: next time you're out shopping or talking with friends about a new brand or service, take a closer look. Start a list of companies that stand out, whether it's a store you keep going back to or a brand that's suddenly popular among your friends. From there, do a bit of research on the company's financials and growth to see if it might be worth investing in. Section 2. Do your own homework. One of Lynch's strongest beliefs was that individual investors should always do their own homework. He used a basic step-by-step process to understand a company's strengths and weaknesses, rather than blindly following trends. Lynch didn't rely solely on what analysts were saying. He looked at the core business fundamentals himself. He encouraged investors to read a company's annual reports, evaluate its revenue sources, and understand how it stacked up against competitors. Lynch had a knack for avoiding companies with hype but no substance, those that might have been trending but didn't offer a unique product or advantage. Instead, he focused on companies with straightforward business models and steady growth. Practical tip: pick a company you're interested in and dive into its financials. Look at its annual reports, sales growth, debt levels, and profit margins. You don't need to become a financial expert overnight. Just try to grasp the basics of how the company makes money and its potential to grow. This step will help you feel more confident in your decision to invest. Section 3. Hold for the long term, but keep an exit. Lynch was a firm believer in long-term holding for solid companies. He didn't buy stocks with the intention of selling at the first hint of a downturn. Instead, he held on to companies he believed in for years, sometimes even decades. He felt that if a company had strong fundamentals, it would eventually weather the market's fluctuations and reward patient investors. However, Lynch also knew when to let go. He understood that some companies lose their competitive edge, and when that happens, it's time to reevaluate your position. He always had an exit plan, a clear marker for when a stock was no longer worth holding. This doesn't mean selling at every sign of trouble, but rather staying attuned to a company's trajectory over time. Practical tip: for each stock you own, establish criteria that would signal a reason to sell. This might include declining revenues, poor management decisions, or simply realizing that the company no longer aligns with your financial goals. Holding for the long term doesn't mean holding forever. It's about staying committed to companies with strong, lasting growth potential while staying flexible enough to adapt if the fundamentals shift. Conclusion. To sum it up, Peter Lynch didn't overcomplicate investing. He looked for simplicity in an often overwhelming field. By investing in what he knew, doing thorough research, and holding with a long-term mindset while always having a backup plan, he turned seemingly basic ideas into a record-breaking career. And the good news is that these principles are accessible to anyone willing to put in a bit of time and thought. Thanks for tuning in to Invest Like. I hope Lynch's principles inspire you to take a fresh look at investing and see it as something you can master through your own observations and research. If you enjoyed this breakdown, don't forget to like, subscribe, and hit the bell for more strategies from the greatest investors of all time. See you in the next video.